Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Wednesday, February 10, 2010. Let's start with the euro-dollar pair, where we saw the euro being pressured in today's trading. We rallied yesterday in the pair on speculation that an aid package would be offered by the European Union, but there have been conflicting reports, especially from German officials, as Germany seems to be the country that would lead such an effort. There was talk that Germany could help Greece by guaranteeing its sovereign debt or buying Greek bonds through a state-owned development bank, but other German leaders said that there was no German-led aid plan in the works. This back and forth has caused a bit of a seesawing of asset prices, and today we have moved in favor of risk aversion as the worries we've had bubble to the surface yet again. Also, helping the greenback in today's trading was Fed Chairman Bernanke's comments, which laid out some of the steps the U.S. Central Bank will take in order to begin tightening monetary policy once the U.S. economy's recovery is on firmer footing. We can see that following a test of 1.38 here, we slid in New York trading with Bernanke's comments coming somewhere in the middle. We pushed below our 50-period moving average. We are looking at 1-hour candles here, and we hit a low at 1.3675. The euro-dollar pair has been in a protracted downswing throughout most of January as we slid from the 1.45 level around January 15th. We could see that we had a sharp decline in the middle of last week following a bit of a counter rally, and we're seeing sort of a similar setup happening this week as we have a bit of a counter rally here, and if the Greek sovereign debt issues are not mitigated, then we could see a continuation of this longer term downswing in the euro. Now 1.36 is a strong support, so if we do have a move back down in favor of the greenback, we'll have to see what happens at that level. In testimony before the House Financial Services Committee, Fed Chairman Bernanke said that the outlook for monetary policy has not changed since the FOMC January meeting, and so he reiterated that low rates are warranted for an extended period, which many take to be 6 months. However, Bernanke did say that the Fed was working to ensure that it had the tools to reverse at the appropriate time the currently very high degree of monetary stimulus. The steps the bank could take would be to raise the discount rate that it charges banks when they need emergency loans. And he said that before long, we do expect to consider a modest increase in the spread between the discount rate and the target federal funds rate. That means that the Fed will be using the discount rate as opposed to the federal funds rate in its initial stages of monetary tightening. Also, the Fed could increase the rate at which it pays banks to keep money at the Fed, which is currently running at 0.25%. That would give banks an incentive to keep money parked at the Fed rather than lending it out. And that would work to raise commercial banks' prime rates, increasing the cost to borrow. Now that's a secondary step, as the discount rate move would be the initial. Now Bernanke couched his statements in that he said that these steps would not be undertaken until the economic recovery is on firmer footing. The comments from Bernanke helped the US dollar-Japanese yen pair to rise in favor of the greenback, which cut the losses the pair had seen in overnight. We see that we remain above the 50-period moving average now, and we have tested the level at 90. U.S. equities did manage to recover some initial losses that it experienced during the morning session, which helps this pair move in favor of the dollar. As we can see, following a sharp slide on last Thursday's trading, we have resumed a bit of a gradual upward move in favor of the greenback. Something along the lines here. So for this week, we do have a horizontal support here at around the 89 level, and that would be the level that we would have to test in order for this to make a further down move. On the upside, we would be looking for the greenback to pair these sharp losses it had seen. So maybe rising to the 90.90 level as an initial level of strong resistance. Turning to some fundamental data, in the US we got the trade balance, where the deficit there widened more than expected in December as the country's imports of petroleum products surged on both higher prices and higher volume. The trade gap widened to $40.2 billion, following November's $36.4 billion. That was the largest trade deficit in about a year, and was led by an 8.4% increase in imports. Exports were up as well, climbing 3.3%, which was the highest since March of 2007. Despite the headline figure, the large jump in exports means that demand from abroad is strong for U.S. goods, which should help industrial production. However, imports did rise substantially, and we'll see how oil prices and oil imports progressed in January and February. Canada also released its trade balance figures, and the gap between exports and imports was at 200 million Canadian dollars. Exports and imports both rose by a similar 1.8%. The US dollar-Canadian dollar pair fell in favor of the Canadian dollar in New York trading, breaking below the 1.0650 level, which had acted as support the last several sessions. Oil prices managed to recover from a drop in morning New York trading, and as did equities in North America. We now test new support around the 1.06 area, which was our low in last Thursday's trading here. Taking a look a little bit further back, we see that we had a bit of a range with support at 1.0550, and that may be a logical next support level for this pair. So we may have just expanded this range to have resistance now at a higher level there. The pound-dollar pair, meanwhile, slid rather sharply following a test of 1.5750. That came in the wake of better-than-expected industrial production data, but then the pound was pressured following comments from Bank of England Governor Mervyn King following the bank's quarterly inflation report. King suggested that the Bank of England may resume its bond buying program, which it paused in its decision last week, but it could restart that program if the economy needed further stimulus. He said it is far too soon to rule out further monetary easing, as well as the outlook for the economy remains highly uncertain. So that caused the pound to reverse its gains that we saw in yesterday's trading, and we now trade back below the 1.56 level, which was the area around our support this week. In that fundamental release from the UK, we saw industrial production for the month of December rise 0.5%, when expectations had it rising 0.2%. Manufacturing production led the increase as it grew 0.9%, also better than forecasts. November's data was revised higher as well. The data should help to revise higher overall GDP growth in the UK, which in the fourth quarter was reported to be up only 0.1%. However, now that these output figures have come in much stronger than expected, traders and investors will look for that GDP figure to be revised higher. With our fundamentals and market highlights out of the way, let's take a look at upcoming releases in the next global session. Tonight at 4:45 p.m. New Zealand releases its manufacturing index, PMI index, which will be followed at 7 p.m. by Australia's Melbourne Institute inflation expectations, and at 7:30 by Australia's employment change and unemployment rate. Overnight we get two inflation measures, the German wholesale price index and Switzerland's consumer prices. Tomorrow, the U.S. will post its jobless claims, its business inventories, and the Treasury budget balance. The Treasury budget was scheduled to be released today, but that was moved because of the snowstorms in Washington. Also to note is the change of retail sales from being released tomorrow on Thursday to now being released on Friday. And that'll do it for today's fundamental recap. For more news, videos, and analysis, please visit our site FXTimes.com. I want to thank you for watching and wish you good trading.